she said that she can hear me. So I want to thank everybody for attending today's webinar on sector trading. And one of our main focuses in trading is to trade sectors along with individual stocks. Sectors, the goal is to invest in sectors that have a very high relative strength, and we actually wind up shorting sectors that have a low relative strength. So we like to trade sectors using both ETFs and ETF options, and it's a big part of our portfolio trading ETF sectors. So today we're going to look at trading the strongest market sectors, and I can show you a website that can instantly tell you the relative strength of all the sectors. So it's a very handy tool to have when you're trading sectors, and I'll give you that website in a minute. And we like to participate in these strong market sectors using ETFs and ETF options. We'll also look at ETF trade management and trading ETF option spreads. We'll also show actual trade examples, trades that we have on right now, trading market sectors. And we have a few trades that you can take tomorrow. There's certain sectors setting up for a buy signal right now, so we'll take a look at those, and we'll have a question and answer session at the end. So as I mentioned, our portfolios at Hughes Optioneering, we have both stocks and ETFs, and we also trade stock and ETF options and option spreads. So a good way to potentially profit in any type of market is to trade sectors, and the goal of the sector strategy is to invest in the strongest sectors with ETFs and ETF options. So we like to take long positions in the strongest sectors and take short positions in the weakest sectors. And right now we don't have any short positions, but we're always keeping an eye out for a market turn where the market turns bearish, and then we start positioning in short positions. And we did this in 2002 and 2008, and we did great with short positions. We were heavily short the markets during those two bear markets, so we did very well during the bear markets trading sectors using put options and put option spreads and bearish ETFs. So let's take a look at some examples of bear markets and bull markets over the same time period. So you'll see from these price charts there's always a bull market and there's always a bear market somewhere. So these just compare different markets over the same time period. This is the Brazil index versus the Internet index. You can see Brazil index in a bear market and the Internet index in a bull market. This is comparing the China index versus coffee, emerging Europe versus the Italy index. So emerging Europe ETF in a bear market, Italy shares in a bull market, and this is the trackers China ETF versus the clean energy index. Again, over the same time period, you can see one's in a bull market, one's in a bear market. The BRIC index versus the Egypt index, and this is back in 2002. We were actually trading these sectors back then, and you can see the S&P was in a bear market, and at the same time, the real estate shares, real estate investment trust shares were in a bull market. So we actually we were long the real estate market, and we were short the S&P. So here's another example. This is the S&P versus corporate bonds back in 2002 during the bear market, S&P in a bear market. The bond, corporate bond index in a bull market. So we traded both sides. We were short the S&P and long bonds back then. Here's a snapshot from 2011 which was a tough year for the market. But you can see the S&P in a downtrend and the Treasury bond index in an uptrend. So we trade these sectors from both sides. So we have a very simple trade selection process with sectors, and we select a sector with a high relative strength. And we usually normally look for a 90% relative strength in that sector, which means that it's performing better than 90% of the other sectors. And then once we find a sector that has a high relative strength, we'll use the Keltner channels to find a low-risk entry point to purchase an ETF or an ETF option. And for bearish trades, we select a sector with a low relative strength, and then we use the Keltner channels to find a low-risk entry to purchase a bearish ETF or ETF put option. So our basic trade selection works in both bull and bear markets. And of course, in the bear, when we're looking for a bearish trade, we're looking for a low relative strength, and then we're looking for the ETF to trade near the upper Keltner channels. When it gets overbought, then we select our bearish trade. So that allows us to get a low risk entry in a bearish trade. And as I mentioned, the bearish sector strategy worked well in the 2007 to 2009 bear markets and 2001 through 2003 bear markets. And we'll also look at trade management, and the whole goal with trade management is to exit losing trades quickly. And also, we don't want to exit winning trades with a small gain. We want to ride the trade and let it develop. And we don't want to get out of the position with a small gain. Otherwise, we could wind up with a portfolio of losing trades if we exit our winners quickly and hold on to our losing trades. So the goal of trade management is simply to exit losing trades quickly and hold on to winning trades. And then we also use options to protect profits with winning trades. So if we have a profit in an ETF that we purchased, we'll create a spread trade that helps protect the profits. And if we buy an ETF option, we also, if we have a profit in that option, we'll also create a spread trade to protect the profits. And when you trade sectors, you reduce the risk and volatility, compared to trading individual stocks, which can be volatile and higher risk. So with sector trading, you're going to reduce your risk and volatility. And holding a sector ETF can reduce the individual stock risk and volatility. And I'll show you some examples of that. These are just price charts of stocks that were in a sector, and the stock, in this first example here, Netflix was down 5.5%. Netflix is in the Internet Index, but you can see even though Netflix that day was down 5.5%, the Internet Index was up 1.5%. So down day for a stock. The individual stocks, of course, have higher risk, and down day for a stock, but up day for the sector. Here's another one, LinkedIn down 6.2% versus a 2% gain for the Internet Index. Twitter down 24%, and the social media index that day actually was up slightly. So a lot more risk with individual stocks and a lot less risk if you trade sectors instead of individual stocks. So the way we select our trades is we go on to etfscreen.com and we select relative strength trends. So you just log on to etfscreen.com, select RS trends, and it'll present a table with the relative strength for each sector, with the highest relative strength at the top. So right now the silver miners index has a 99.6% relative strength. So there's only so that's the highest ranked relative strength right there, silver miners, and you can see it lists the relative strength in descending order. So we simply want to log on to this website and take a look at these high relative strength sectors, and those are the ones we focus on. And at the bottom of the list, you have the sectors with the lowest relative strength, and these are the ones you want to look at if you want to take a bearish position. So it goes all the way down to VXX. I believe that's a VIX index, and that only has a relative strength of 1.1. So this is the bottom of that relative strength list, and you can see relative strength declines as you go down the list. And also it's color coded too. So the dark green obviously are the sectors with the strongest strength, and then the white are the sectors with the lowest relative strength. So this is a handy tool to use when you're trading sectors. And as I mentioned, we like to look at relative strength around 90% or higher for our sector trades. And then once we select a sector we want to trade, then we use the Keltner channels to find a low-risk entry. And these Keltner channels, they act as an overbought, oversold indicator, and they help us time our trade entry and exit points. They also provide high probability buy and sell signals, and we also use them to select option strike prices. So let's look at an example of the Keltner channels. This is the healthcare sector spider, symbol XLV, and this ETF has a basket of healthcare stocks. So this is the daily price movement of the sector here in the black and red vertical lines, and then we have the upper Keltner channel, which is this blue line, the middle Keltner channel, which is the dotted blue line, and then the lower Keltner channel, the lower blue line right here. So the Keltner channels act as an overbought, oversold indicator, and when the ETF is trading near the upper band, then it's getting overbought. So you don't want to buy the ETF when it's trading up near the upper channel or above the upper channel. Instead, we like to wait until it retraces to the middle or lower Keltner channel before we buy. And you can see that the healthcare sector follows a very predictable pattern where it gets overbought and then sells off, gets oversold and then rallies, overbought, sells off, rallies, overbought, sells off, rallies. So it follows a very predictable pattern, and we like to use these patterns to enter our trade. So if we want to take a long position, you definitely don't want to take a long position when the ETF is trading at or above this upper channel. You want to wait for a retracement to the middle or lower channel. So a very handy tool to help us enter our trades. So let's look at some current trade examples that we have on right now. And the ETFscreen.com is showing VNQ, which is the Vanguard Real Estate Investment Trust, with a 93.5% relative strength rating. So it has a higher relative strength than 93% of the other sectors. So we focused on this one, and you can see it's been in a strong uptrend for a while now with this dark green color. So we like to focus on the sectors that have relative strength of 90% or higher. So we could see that VNQ had a high relative strength, so we waited until it retraced to the middle Keltner channel. It was getting oversold here, so on the bounce when it was near the middle Keltner channel, we went ahead and bought 600 shares of VNQ at 78.20, and that's trading around 92 now. So that provided a good entry point. And if you notice, it didn't retrace much from our entry point. So that's the advantage of using these Keltner channels to select your entry point, because the VNQ did not retrace much from when we purchased it. And we currently have, this is our stock portfolio, stock and ETF portfolio, and we currently, in VNQ, we have a $27,000 open trade profit in that sector. Here's another example. This is for the dividend stock ETF, and this ETF holds a basket of dividend-paying stocks, and we can see it had a 90.3% relative strength, and we wanted to jump in and purchase the DVY. The symbol for the dividend fund is DVY, and you can see in a very strong uptrend, and the question is, if you want to participate in this uptrend, where do you jump in to buy it? So we wait for a retracement, and right in here, it retraced to the middle Keltner channel, so we bought 400 shares of DVY at 81.57. So it didn't retrace much from our entry point, and is now profitable, and we currently have open trade profit around 18,000 in the dividend fund. Here's one more example. This is for the utilities ETF, symbol XLU, and that has a 94.5% relative strength. And again, you can see the daily price movement of XLU going from lower left to upper right. So a very strong uptrend. The question is, where do you jump in? So we waited until this retracement towards the middle channel, and then we bought 1,000 shares of XLU at 46.26. And then we have an open trade profit of $16,000 in the XLU. So you can see from these examples that the using the Keltner channels resulted in low-risk entries, as the ETFs didn't retrace much from our entry point. So this helps prevent getting stopped out of our position. So let's look at some, this is our total portfolio right now. Most of these are ETF positions. We have the dividend ETF, $18,000 profit. This HTD, this is a really interesting one. This is a preferred stock fund, and we have a $19,000 profit on that one. This is the QQQ, the NASDAQ index, 14,000 open trade profit. The real estate investment trust ETF, $27,000 profit. Energy ETF, consumer staples, and utilities ETF. So most of our positions are ETFs. So let's now look at the ETF option strategy, and we also trade options on the strongest ETFs. And the trade selection is the same for purchasing an ETF. The option strategy trade selection is the same. We select a sector with a high relative strength. We like to see 90% or better. And then before we buy a call option, we want to use the Keltner channels to find a low-risk entry for our call option purchase. And then we use what we call the 1% rule to select the option strike price. And options are derivatives, and they derive their value from the price movement of the underlying stock. So we use ETF relative strength to identify ETFs that are moving up in price. And if you can identify an ETF moving up in price and you buy a call option, that allows you to profit from the tremendous leverage that call options provide. So let's look at some sector option trades that we have. The first one's for the utilities ETF, and again, we we saw in the previous example when we purchased the ETF itself, 94.5% relative strength. So we also bought the XLU 42 strike call at 630 right in here as the stock retraced, the XLU ETF retraced towards middle Keltner channel. We jumped in and bought the 42 strike call. And again, it got us a low risk entry. And we can see we bought the April 40 strike call at 630 right in here. And we have since rolled this option over to a September option, and we're still profiting from this trade that we took back at the beginning of March. So again, Keltner Channels allowed us to get a low risk entry for our ETF option trade. And the XLU has recently retraced towards that lower Keltner channel, so that's one worth looking at if you want to purchase the sector right here, the ETF symbol XLU, or buy a call option. You can see it got overbought there in July and now has retraced towards that lower Keltner channel. So that's worth looking at to purchase either the ETF or an option. Here's the Vanguard Real Estate Investment Trust ETF again, and has a high relative strength, 93.5, and we waited for it to retrace here. It was in a pretty strong uptrend, so we waited for it to retrace, and then we bought the September 70 strike call at 1334. So we bought right in here, and with it trading up around 90, we have a nice profit in this September 70 call that we bought in mid-April right in here. And VNQ is also on a buy signal right now because it got overbought. Now it's retraced towards that middle Keltner channel, so that's another one worth taking a look at for a long position. And the last example is that dividend ETF DVY, 90% relative strength, and we went ahead and bought the September 70 strike call at 1170 right in here when it retraced towards the middle Keltner channel, and again that gave us a low risk entry, and now we have a nice profit on this option. And also DVY is also has retraced towards that middle Keltner channel, so that's another one worth taking a look at for a long position. So again, with the option trades, just like the ETF trades, the option trades, the Keltner channels resulted in low risk entries, and as the underlying stocks didn't retrace much from our entry point, and that helps prevent getting stopped out of the position. Here's our ETF option portfolio. This has a average open trade profit of about 42%. So this lists our ETF option trades and average return of about 42%. And one other thing I wanted to mention when you're purchasing an option is we use what we call the 1% rule for selecting that option strike price. So once you select an option trade, there's hundreds or even thousands of strike prices to choose from. So selecting the strike price is very important because you have so many different strike prices to choose from. So that becomes a very important part of the trade selection. So option premiums consist of time value and intrinsic value, and options lose all time value at expiration. So when you buy an option, you're buying a decaying asset, and each day the time value of that option is decaying, and when you get to expiration, options have no time value. Their time value goes to zero. So you always want to keep that in mind whenever you're trading options, that you're buying a decaying asset, and it decays a little bit each day until expiration. So due to these time decay characteristics of options, when buying an option, you want to minimize time value because that's going to decay to zero, and you want to maximize the intrinsic value of the option. And the way we do that is we limit the time value portion of the premium to less than 1% of the stock price. And if you do that, then you'll minimize the time value, maximize the intrinsic value. So if you purchase an option and the stock is trading at 100, then you want to limit the time value to 1 point or less, which is 1 point would be 1% of the 100-point stock price. So if you limit that time value portion to 1% or less of the stock price, then you're going to maximize the intrinsic value, minimize the time value. Here's an example. This is the dividend ETF 70 strike call, September 70 strike call that we purchased for $11.70. So when we purchased the 70 strike call, the ETF, underlying ETF, DVY, was trading at 81.38. So this is an in-the-money call, as the 70 strike price was less than the current stock price of 81.38. So these, if you use the 1% rule, then you're going to be buying in-the-money calls. And let's look at the breakdown on that option premium. The DVY ETF was trading at 81.38. The call strike price was 70, so we bought the 70 strike call. If you subtract that strike price from the stock price, you get an intrinsic value for the option. In this case, the intrinsic value was 11.38. So the total option premium was 11.70. We paid 11.70 for the option. So the total premium was 11.70. If you subtract the intrinsic value of 11.38 from the total premium, then you get the time value. In this example, the time value was only 32 cents. So what that means is the DVY ETF, it only has to go up 32 cents for this option trade to break even and for us to start profiting. So that's a very small price increase in the ETF, and then we start profiting with the option. So ETF only has to, in this case, go up 32 cents, and we start profiting on the option. And we developed a series of 6 different calculators that will calculate the profit potential for our option strategies before we make the trade. So this is the call option purchase calculator, and what this does is calculate the profit potential for this trade that we made when DVY was, the stock price was trading at 81.38. We bought the 70 strike call at 11.70. So what the calculator do is calculate the profit potential for this trade, assuming various price changes in DVY at option expiration, and from, in this case, a 30% increase in the price to a 5% decline in the price. So it'll calculate the profit potential, and the bottom row right here gives you the percent return for the corresponding change in the ETF price at option expiration. So we can see if the ETF was up 20% at option expiration, then the option would have a 136% return. If the ETF is up 10%, then the option will have a 66% return. If the option is flat at 81.38 at option expiration, then the option will have a 2.7% loss. So we'd much rather buy these in the money calls, and you can see if the stock's flat at expiration, we only lose 2.7%. Now, if we bought an at the money or out of the money call and the stock is flat at option expiration, then you lose 100% of the premium. So we don't want to ever be in that position. So we buy these in the money calls, and you're less leveraged, but at the same time, you can still make a good return. And in this example, if the ETF's up 10%, even though it's an in-the-money call and you paid more for the call, you're still going to get a 66% return. So that's a pretty good return. And for an in-the-money call for a 10% increase, and again, if it's up 20%, we make 136%. So the option purchase calculator also will calculate the time value and the intrinsic value. And in this example, the time value was 32 cents, intrinsic value was 11.38. So you can see with the premium trading at 11.70, this is mostly intrinsic value, and that's why we use the 1% rule. So to summarize, with 32 cents of time value, DBY only has to increase 32 cents or 0.4% for this trade to break even, and any increase in the stock price above 32 cents will result in a profit. So it doesn't take long with these in-the-money calls. If your timing is good and DBY goes up 32 cents, then you start making money. So we'd much rather trade these in-the-money calls than out-of-the-money calls. Out-of-the-money calls typically can require a 10 to 15% move in the underlying stock just to break even on the trade. And many times the stock or ETF, it will not make that expected price move at option expiration. And if you have an at-the-money or out-of-the-money call and the stock is flat or down at all, then you'll lose 100% of your premium. So the goal is we don't want to take these big losses. So we use this 1% rule to select the option strike price. So let's just talk about the trade management for a minute. And for the option trades, the goal with the trade management is to exit losing trades quickly, and we don't want to exit our winning trades with a small gain. So if you hold on to the losing trades and you exit your winning trades with a small gain, you're eventually going to wind up with a losing portfolio. So we want to practice this discipline of exiting these losing trades quickly and holding on to our winning trades. And we also, part of our trade management is if we have a profit in an option, then we want to protect that profit, and we create a spread trade that helps protect the profit. So we have 3 money management rules. We use a stop loss rule of 20%, and we'll also roll over at option expiration if the stock is still on a buy signal. In this case, with ETF, if it still has a high relative strength and the trade is profitable, then we'll roll over the option at option expiration. And then we also have what we call the 30% rule for protecting profits, and whenever we have a profit, we want to create a spread trade. So let's talk about the first trade management rule, which is the 20% rule for walking away. And the goal of this rule is to prevent a small loss from developing into a big loss. And if an option's price drops 20% below our entry price, then we simply want to exit the trade. And we definitely want to be out before it reaches a 30% loss. So when you get out with a 20% loss, this helps prevent a 100% loss potential in the trade. So we want to practice this discipline of exiting these trades quickly if we're wrong, and sometimes we are wrong. And again, just as an example, we bought the dividend ETF 70 strike call at 11.70. So in this trade, if the price of the option drops 20% to around 9.36 on a closing basis, then we'll simply exit this trade, and this helps prevent a total loss of the option premium, and allows you to stay in the game. So you want to exit these losing trades before they develop into big losing trades. So if you incur a 20% loss on a trade, it only takes a 25% return on the next trade to break even. So let's say we have a bad timing on our entry, and we take our 20% loss on our option premium, and then we go into the next opportunity. We only have to get a 25% return on that new opportunity to break even from this 20% loss. But look what happens if you hold on to that losing trade and you incur a 50% loss. Then it takes a 100% return on the next trade to break even. So we don't want to take these big losing trades because it's really hard to make up for these losing trades. So a 50% loss, the next trade, you have to have a 100% return to break even. So how many 100% wins have you had lately? So my point is we want to exit these trades before they develop into big losses. And if you take a 75% loss on a trade, the next trade has to have a 300% return just to break even. So we don't want to take these big losses. So we'll take a 20% loss, and then we move on to the next opportunity, and that's all part of the trade management. And then another trade management rule we use is we roll over at option expiration if the ETF is still on a buy signal and the trade is profitable. So when we roll over our profits into the new trade, then that reduces the risk and allows us to compound our returns and allows us to play with the house's money. So once we enter these trades and we start to profit and we start rolling over, a lot of times it only takes 2 or 3 rollovers, and we'll reduce our risk to zero on the cost of the option. Of course, then we have no risk at that point. Here's some examples of rollovers. This is for the QQQ NASDAQ index, the VNQ Real Estate Investment Trust index, Consumer Staples Index XLP, and Utilities Index. And these are just examples of rolling over the profits from the option that's expiring into the new trade. So with the QQQ, we had a $509 profit. With the VNQ real estate, we had a $319 profit, $216 profit for the XLU. So when we closed out the expiring option, then we rolled over those profits into the next option. So in the case of the XLU, we had a $216 profit. So we closed out the April call with a $216 profit. Then we bought the September call at $690, but the $216 profit reduced that new cost from $690 to $474. So what that did is it reduced the risk by 31% because our new cost is $474 at risk instead of $690. So this reduced the risk of the new trade. Here's another example. The QQQ, we had a $509 profit. The September 100 call cost $1288. So if you subtract that profit from the new option cost, then we have a reduced cost basis of $779. So this reduced our risk by 40% on the new trade. So we like to do that, and we typically, after 2 or 3 rollovers, will reduce our cost base to zero. So again, rolling over options reduces the risk and allows us to compound our returns, and a lot of times we can reduce that risk to zero, and then we start playing with the house's money. So let's talk about the last strategy, and that's the ETF option strategy. And our third trade management rule is to use the 30% rule for protecting profit. So if we have a 30% profit in a call option, then we'll sell a call option with a higher strike price, and that creates an option debit spread. So if we buy a call option, we have a 30% profit, then we'll sell a call option with a higher strike price, and that creates what's called an option debit spread. And if you purchase an option and then you have a 30% profit, the sale of the call option at a later date will increase the profit potential of the existing option purchase and will also provide downside protection in the event the underlying stock or ETF decreases in price. So you accomplish two things when you create these debit spreads. You increase the profit potential of the existing option purchase, and it also provides downside protection. We'll show you some examples of that. So when you have a bullish debit spread, the call option purchased will profit if the price of the stock increases, and the call option sold will profit if the price of the stock or ETF decreases, and then your risk is limited to the cost of the spread. So let's look at an example. We bought the XLU 42 strike call at 474. So this shows we own the September 42 strike call at 474. So we had a profit in that, and then at a later date, we sold the XLU 48 strike call at 190 to create an option debit spread to protect the profits. So again, sold the September 48 strike call at 190. So bought the 42 strike call at 474, sold the 48 strike call at 190, and we have when we did that, when we sold that 48 strike call for 190, $190 in cash went into our brokerage account, and that increased the profit potential of the 42 call that we already own. So when we sell the 48 strike call short at 190, that increases the profit potential of the existing 42 strike purchase. And it also provides downside protection if the ETF declines in price. And we have an option, call option spread calculator. And again, this will calculate the profit potential for the option spread, assuming various price changes in the underlying ETF at option expiration. In this example, from the 7.5% increase in the price to a 7.5% decrease in the price at option expiration. So again, with XLU trading at 50.32, we bought the 42 strike call at 474, sold the 48 strike call at 190. So we can see that if XLU is flat at option expiration at 50.32, we're going to realize a $316 profit on the spread, and that represents 111% return. So, so in this case, we can profit on XLU if it is flat at expiration, we'll get 111%. If it goes up at all, we'll get 111% return for the spread. And if it goes down 2.5%, we'll still have a profit of $111 or 111%. And if it goes down 5%, we have 104% return. If it goes down 7.5% to 46.55, we'll still have a profit on the spread of 60%. So in this case, we had a profit in the 42 strike call, sold the 48 strike call, and that increased the profit potential of the 42 strike purchase, and also at the same time provided downside protection. And you can see that if its stock goes up at expiration or is flat or is even down 2.5%, then we'll we'll still get 111% return, which is a great return for the utility ETF. And even if it's down slightly at 5%, 7.5%, we'll still realize a profit on the trade. So in this example, creating the spread increased the profit potential and also reduced the risk. Here's another example. This is for the QQQ. Bought the 100 strike call at 779, and then we had a profit in that trade, so we sold the September 109 call at 440. So again, we bought the 100 strike call 779, and we sold short the 109 strike call at a later date at 440. So let's look at the risk profile on this, and we can see the call option spread analysis on this one shows if the QQQ is flat at expiration, we get 165% return. If it's up at all at expiration, 165% return. And then if it goes down 2.5%, we get 133% return. If it's down 5%, we still get a 51% return. And then if it goes down 7.5% at 102, then we will realize a loss on the profit. So in this case, we do the spread does provide some downside protection, and also we get a great return if the index is even flat at option expiration. We'll get 165% return. So that's another example of we had a profit in the 100 strike call, sold the 109 strike call at 440. So that increased the profit potential for our existing purchase and also gave us downside protection. Okay, and this is our current portfolio. And in this we have ETF option purchases, and we also have the spread trade. You can see the 100 strike, 109 strike, QQQ spread right here, the VNQ, the 70, 83 strike spread. So we create these spread trades whenever we have a profit in our option purchase. So just to recap, the spread trades, they increase the profit potential of the existing option. They provide downside protection, and they can reduce your risk because when you sell a call option, that reduces your risk. So on the realty income spread, the cost of the call option purchase was $879, but after we created the spread, our total risk was $429. On the QQQ, we purchased the call option at $779. After we created the spread, our risk went down to $339. So it reduces your risk, and it can be profitable if the stock goes up or down, and you're limited. Your maximum loss is always limited to the cost of the spread. So I just want to mention real quickly the one more spread strategy that we use for call option purchases, and that's the market neutral strangle. And with the market neutral strangle, if we have a profit in a call option, then at a later date we'll buy a put option to protect the profits. And if you set these up right, they can, when you buy that put option, it can even guarantee a profit for your call purchase no matter what the underlying stock or ETF does. So what we do is if we have a profit in a call option, then at a later date we'll purchase that put option to create that market neutral spread trade. And of course, the call option purchase profits if the price of the underlying stock increases, and the value of the put option purchased will profit if the price of the underlying stock decreases. So you have a long position and a short position with these market neutral trades, and your risk is limited to the cost of the spread. And when you put on these market neutral spreads, there's no limit on the profit potential of the spread, if the underlying stock continues to increase in price, and at the same time, you can lock in and guarantee a profit for your trade. So let's just look at an example quickly. This was for NASDAQ ETF QQQ. We used the sector strategy to select this NASDAQ call option. We got a low-risk entry point using the Keltner Channels, and then we used the 1% rule for selecting the option strike price. So the trade was profitable, so we used the 30% trade management rule for creating an option spread. And in this case, we did a market neutral spread. So we bought 14 of the QQQ January 80 calls at 861. So bought 14 of the QQQ January 80s at 861, and then we had a profit in that, so we went ahead and bought 14 of the QQQ 93 strike puts, and we paid 165 for the puts. So I had a profit in the call, bought a put option to protect those profits, and let's take a look at the risk profile for a market neutral trade. And again, the calculator will calculate the profit potential assuming various price changes in QQQ at option expiration from a 30% increase to a 30% decrease. And again, we bought the 80 strike call at 861, bought the 93 strike put at 165, and you can see if the QQQ is flat at expiration at 99.22, then we'll have an 80% return on this spread. We'll have an $896 profit and an 87% return if the stock is flat at option expiration. And then if the ETF is up 10%, we'll have a 184% return. So with these market neutral spreads, you can see the profit potential is not limited by buying that put. 10% increase is 184% return. 20% increase in the ETF is a 280% return. So your profit potential keeps increasing. And here's the really interesting part. If the ETF goes down 10%, we still make a 26% return. And then if it goes down 20%, we have a 32% return. Goes down 30%, we have a 129% return. So even if the ETF goes down in price, the more it goes down, the more we make. So that's an interesting side note for these market neutral trades. So your upside potential is not limited, and your downside potential is not limited either. So a great way to trade options if you want to really reduce your risk is to create these market neutral spreads. And in this example, we set it up, and we're guaranteed a minimum profit of 26% no matter what happens. So this is a way to, if you have a profit in an existing trade and you don't know what to do, then you create one of these market neutral trades to guarantee your profit. So that concludes my presentation today.